urgent. Canadian seniors, listen up. The government just changed income thresholds, and this could affect your OAS and CPP payments. Some of you might even lose benefits if you don't act now. In this video, I'll break down exactly what's happening with the latest pension updates and the ongoing crisis affecting retirees across Canada, so you know what to watch for and how to protect your income. Make sure you subscribe now, because this channel is dedicated only to helping Canadian seniors stay informed and get every dollar they deserve. You won't want to miss future updates. If you're a Canadian senior, or if you love someone who is, then what you're about to hear over the next few minutes could directly affect how much money lands in your bank account this year. We're talking about income thresholds, those magic numbers that determine whether you keep getting your full benefits, whether you get more, or whether the government quietly starts clawing back money that you thought was yours. And in 2026, those numbers have changed. So before you assume that everything is fine, before you assume that your benefits are exactly what they were last year, you need to understand what's shifted and why it matters so much to get this right. Let's start with the big picture, because so many Canadians don't actually understand how the retirement benefit system works as a whole, and that lack of understanding costs real money every single year. Canada's support system for seniors rests on three main pillars: the Canada Pension Plan, which most people call CPP, Old Age Security, which is known as OAS, and the Guaranteed Income Supplement, or GIS. Each of these programs has its own rules, its own income thresholds, and its own adjustment schedule. And in 2026, all three have been updated in ways that you need to know about, because some of those changes help you, and some of them, depending on your situation, could hurt you if you're not paying attention. Let's begin with CPP, because it's the one that most working Canadians have been contributing to their entire lives. As of January 2026, CPP payments have increased by 2.0%. Now, after the large inflation-driven jumps of recent years, we saw increases of 6.5% and then 4.4% in previous years. A 2% bump might feel a little underwhelming. And honestly, for many seniors, it is. Groceries are still expensive. Rent hasn't come down. Heating bills haven't gotten any friendlier. But the increase is real. And it is automatic. You don't need to call anyone. You don't need to fill out a form. And you don't need to apply for anything. If you were receiving a CPP payment of $1,000 a month in 2025, your 2026 payment is now $1,020 a month. That's an extra $240 a year. Not a fortune, but not nothing either, especially when it compounds with your other benefits. What's more significant for working Canadians, and for those who are still earning income while receiving CPP, is that the year's maximum pensionable earnings, the income ceiling used to calculate your CPP contributions, has jumped considerably. For higher earners, this means more money is being taken off each paycheck in contributions, which can be a shock if you weren't prepared for it. But for younger Canadians still building their CPP entitlement, it also means a higher future pension, because the CPP enhancement that started back in 2019 is still rolling forward, and by the time it's fully phased in, workers who contribute throughout the enhanced period could see CPP replace up to 33% of their pre-retirement earnings, compared to just 25% under the old system. That's a meaningful difference over a long retirement. Now let's talk about OAS, because this is where things get particularly interesting, and where a lot of seniors get caught off guard. Old Age Security is the monthly payment that most Canadians aged 65 and over receive, and it's adjusted every single quarter based on the Consumer Price Index, the government's measure of inflation. For the January through March 2026 quarter, OAS benefits increased by 0.3%. That might sound tiny, but when you add it to the increases throughout 2025, OAS has actually risen by about 2.0% over the past year. In real dollar terms, if you are between 65 and 74, your maximum OAS payment is now approximately $742.31 per month. If you are 75 or older, you receive even more, around $816.54 per month, because of a permanent 10% enhancement that was introduced in 2022 specifically to account for the higher costs that come with aging, things like healthcare, medication, and home support. But here is the critical part. Here is the part that trips up thousands of Canadian seniors every single year. OAS is not just a flat payment that everyone gets equally. Once your income crosses a certain threshold, the government starts taking some of it back. This is called the OAS recovery tax, but most people know it by its more intuitive name, the clawback. And in 2026, that clawback threshold has changed. For the period from July 2026 through June 2027, based on your 2025 income, the clawback begins at $93,454. Compare that to the 2025 threshold of $90,997, and you'll see that the threshold has actually moved higher, which is good news. It means more seniors can earn a bit more income before the government starts recovering their OAS. But, and this is a very important but, once your income exceeds that threshold, you lose 15 cents of OAS for every dollar you earn above it. And if your income climbs all the way to $154,708 as a 65 to 74-year-old, or $160,647 if you're 75 or older, you could end up repaying every single cent of your OAS. Gone, completely wiped out by the recovery tax. So who does this actually affect? The clawback isn't something that most Canadian seniors need to worry about, because the threshold is set at a fairly high income level. But for seniors who have significant RRSP or RRIF withdrawals, investment income, rental income, or who are still working part-time, those income sources can add up faster than you might expect. And the trap that catches many people is that the clawback is assessed on your net world income, meaning it includes income from everywhere, not just Canada, not just employment. It includes your CPP, your private pension, any dividends, capital gains, foreign pensions, and yes, it includes your OAS itself in the calculation. If you weren't expecting that, and millions of Canadians aren't, it can come as a very unpleasant surprise when you file your taxes. The smart move, if you're anywhere near that threshold, is to think about your income timing strategically. Some seniors choose to defer OAS altogether, which allows you to receive a higher monthly amount when you do eventually start collecting, 0.6% more for every month you delay, up to a maximum 36% boost if you defer all the way to age 70. For a senior in good health who expects to live into their 80s, deferral can be a genuinely powerful financial strategy. Others look at spreading out their RRIF withdrawals over more years to keep annual income below the clawback threshold. These are the kinds of conversations worth having with a financial advisor who understands the Canadian pension system inside and out. Now let's shift to the benefit that matters most for the most vulnerable seniors, the Guaranteed Income Supplement. GIS is a non-taxable monthly benefit on top of OAS for seniors with low income, and it is one of the most important yet least understood parts of the Canadian benefit system. For 2026, the GIS thresholds have been updated, and this matters enormously because if your income creeps above those thresholds, you could lose your GIS eligibility entirely. For a single senior, widowed senior, or divorced senior, the income cutoff is $22,180 per year. That means if your annual income from sources other than OAS is below that number, you are entitled to GIS. The maximum monthly GIS payment for a single senior in the January through March 2026 quarter is substantial, reaching close to $1,097 per month at the maximum, though your exact amount depends on your income. For couples, the thresholds are different. If both you and your spouse are receiving a full OAS pension, your combined income must be below $29,712 per year to qualify. If your spouse doesn't receive OAS and isn't receiving the allowance, the combined income threshold rises to $53,704. And if your spouse is receiving the OAS allowance, a separate benefit for low-income partners aged 60 to 64, the combined threshold is $41,616. These numbers might seem like a lot to keep track of, and they are. But they are critically important because the difference between qualifying and not qualifying for GIS can be worth thousands of dollars a year to a low-income senior household. One thing that many GIS recipients don't know is that the income calculation comes with a working exemption that can really help. The first $5,000 of any employment or self-employment income is completely excluded from the GIS income calculation. And for earnings between $5,000 and $15,000, only 50% of that income counts against your GIS eligibility. That means a senior who is still doing part-time work can potentially earn up to $15,000 and only have $5,000 of it counted when the government decides whether they qualify for GIS. That's a meaningful carve-out, designed to encourage seniors to keep contributing economically without being punished for it. There is one thing that can completely derail your GIS, and that's failing to file your taxes on time. This is not a small risk. Every year, GIS payments are calculated based on your previous year's tax return. If you are supposed to be filing a 2025 tax return and you don't get it done by April 30th, 2026, Service Canada can interrupt your GIS payments. They have no other way to verify your income. And when payments are interrupted, it can take months to sort out, leaving vulnerable seniors without income they desperately need. If your income is low and you haven't been filing taxes because you thought you didn't need to, please understand. Filing your taxes every single year is absolutely essential to keeping your GIS flowing. It is one of the most important things any low-income senior can do. Now let's talk about the allowance, because this is a benefit that a surprising number of Canadians have never even heard of. If you are between 60 and 64 years old, and your spouse or common law partner is an OAS and GIS recipient, you may be entitled to receive the allowance even though you're not yet 65. For 2026, you qualify if your combined household income is below $41,616, and the maximum allowance payment is $1,409.72 per month. There's also a version of this benefit called the Allowance for the Survivor, for people between 60 and 64 who are widowed and have a low income. In 2026, the income threshold for that program is $3,312 per year, and the maximum benefit is $1,680.47 per month. These programs exist specifically to prevent poverty among near seniors who have lost a partner or whose partner cannot yet receive OAS. If you or someone you know might be eligible, it is absolutely worth exploring. Let's zoom out for a moment and talk about the big picture strategy, because all of these programs interact with each other in ways that make personal financial planning genuinely complex. The CPP increases your taxable income, which can push you closer to the OAS clawback threshold. Your RF withdrawals count as income, which affects your GIS eligibility. The order in which you start taking different benefits matters. The province you live in matters too. Provinces like Ontario, British Columbia, and Alberta have their own top-up programs that layer on top of the federal benefits, and each has its own rules about income eligibility. In Ontario, the Guaranteed Annual Income System, known as GAINS, provides extra support to low-income seniors below certain thresholds. In British Columbia, there's a monthly senior supplement for those who qualify. These provincial programs are worth looking into because they can add meaningful income on top of what you're already receiving federally. One more thing that is worth addressing directly, because it comes up constantly, is the question of whether higher CPP payments could cause some seniors to lose their GIS. The short answer is, it depends on your income level. Higher CPP payments do count as income for the purposes of GIS eligibility. But here's the key. The GIS thresholds themselves are also adjusted annually to account for inflation and rising benefit amounts. The government has explicitly committed to ensuring that routine CPP increases do not result in unintended GIS losses for low-income seniors. That said, if you've had significant changes in your income, an inheritance, a pension payout, a large RRSP withdrawal, the sale of a property, those are the kinds of events that can genuinely push you over the GIS threshold in a given year. If something like that happened in 2025, your 2026 GIS eligibility will reflect it when Service Canada reviews your tax return. The bottom line here, the thing we really want you to walk away understanding, is that the Canadian senior benefit system is not static. It moves every year. Thresholds shift, amounts change, new rules come into effect. And the difference between understanding those changes and ignoring them can be thousands of dollars over the course of a year. The good news is that 2026 is actually a relatively positive year for most seniors. Thresholds are up, payments are indexed to inflation, the clawback threshold has risen, and the government has maintained its protections for the lowest income recipients. But relatively positive doesn't mean automatically handled. You still need to file your taxes. You still need to check your MyService Canada account to verify your payment amounts. You still need to think about whether your income situation in 2025 could affect what you're entitled to receive from July 2026 onward. If you're unsure about any of this, if the thresholds, the clawbacks, the GIS exemptions, the deferral math, if any of it feels complicated, That's because it genuinely is complicated. Canada's senior benefit system is actually one of the most comprehensive in the world, but it rewards people who understand it and quietly underserves people who don't. So talk to someone. Talk to a financial planner who specializes in retirement income. Call Service Canada. Visit your local Service Canada center in person if that's easier. Share this information with a parent, a grandparent, a neighbor, a friend who might be missing out on benefits they deserve. Because the money is there. The programs exist. The thresholds have been updated in your favor. The only question is whether you know enough to take full advantage of everything you've earned.